Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today, we have Fernando Angelucci, and in the past 6 years, he has transacted on 53 self-storage facilities across 24 states, amounting to $230 million in revenue. And he specializes in using creative deal structuring to purchase cash flowing assets. And we'll get more into this once he'll get way deep into this, trust me. Institutional grade self-storage facilities, and he provides investors with access to deeply discounted off-market facilities and capital strategic partnerships and opportunities for passive investors. Fernando, welcome to the show.
Thanks for having me, Weston.
Of course. Yeah, so Fernando, tell us a little bit about your background. You started about 10 years ago in the space, and how did you see the opportunity, and what brought you to self-storage?
Yeah, so I'll give you kind of like the 30-second overview. Son of two immigrants. The American way was to go to school, get good grades, go get a job with a pension, and then go, retire after 40 years. So when I was 16, I ended up reading the book Rich Dad, Poor Dad, changed the way that I looked at how I was going to make money. From there, I started flipping houses. I did go to school, got my engineering degree, but very quickly lasted maybe 13 months in the 9-to-5 space. And then started flipping houses, buying rentals, buying apartment rentals. And then eventually I got tired of the tenants, the toilets, the trash, and went into non-habitation based commercial real estate, which was self-storage, right? So started the self-storage journey after I sold all of my multifamily assets. And then from there, we started building up just a self-storage strategy until today. So over the last 6.5 years, we're actually up now, I think, to 55 deals and $255 million in transactions.
Awesome. So I'm sure you get this question a lot, Fernando. Why self-storage?
There's so many reasons. So like I said before, just the stress threshold. I don't want people living in my investments. That's too much risk. It's too much liability for my investors. And one of our 3 tenets is downside mitigation for the investors. So we want to make sure that we're controlling all variables. And unlike let's say, a apartment building or a mobile home or a single family home, if a tenant decides that they no longer want to play by the rules and they want to try to game the system, that could be up to, depending on where you are, it can be up to 8, 9, 10 months before the eviction goes all the way through and you get the writ of removal. And during that time, they can cause, substantial damage that can be anywhere between 2 to 5 years worth of profitability. So just not something that I really like. The other thing that I noticed was this trend that's going on in the United States of government getting involved in private real estate investments because they view it as a basic human right, which I don't want to argue against that fact. But when the government can come in and tell your tenants that they don't have to pay rent and you're not allowed to evict them, but at the same time they're telling the investors that you still have to pay your mortgage, you still have to pay your property taxes, or we will take your property away from you. I just think that's too much government intervention into an asset. So to mitigate against that risk, we went into self-storage, which is not viewed as like a basic human right. If somebody doesn't pay on their unit for, let's say, 30 days, 45 days, I can auction off their possessions. So the difference between tenant law or landlord law and lien law or auction law. So when somebody puts their possessions into my unit, they automatically give me a lien against their possessions based on the state compiled statute. So state law, it's codified. And within 30 days of non-payment, 45 days, depending on which state you're in, you not only recover all of your lost rents, but you also have a new tenant that's in there. And it's pretty difficult to damage concrete and steel, especially if the day that they become late on their payment, they're locked out of the facility by the keypad. So you can't, when a tenant is late on their rent, you can't lock them out of their apartment until they pay. But that is something that you can do in storage. So a lot less risk to the investors, a lot more control. And then not to mention super high sticky rates, recession resilient, which I can go into more later. I have a bunch of numbers here in front of me. Um, and then the ability for the asset to, it's not a high cost, right? So when you're looking at all your monthly costs, you got $2,000 rent, you got this and that, you got groceries, $100 for a storage unit, that's easy to pay. And sometimes when you're having trouble, um, it's easier to pay the lower bills than it is to pay these larger bills. And then, we are a business that works with transition. So if you're downsizing, if you got a divorce, if you are moving jobs, if you're moving cities, all these people need self storage regardless of how the economy is doing. So we're recession resilient, but we're not necessarily counter cyclical because in good times, people are buying more things and they're putting them in storage because they don't have room in their houses.
Totally. Yeah, and that's why self-storage is a great investment, right? People leave their stuff in there and they don't want to move it. So, what makes a good self-storage investment? What do you look for exactly, and how do you find those opportunities that stand out?
Yeah, so great question. And it really depends on, how big are you and how big is the company that you've built around this investment. So in the beginning, I was totally fine buying small facilities, less than $1 million, um, 16, 17, 18,000 square feet, doing all the management myself, learning the game, right? And I made money off of those deals. My very first deal I bought for less than $1 million, just shy of a million. And in 3 years, we sold it for 18 or $1.8 million. So we were able to get the investors a pretty solid return. Nowadays, though, we're at a point where we have so much scale, we have so much investor capital that it doesn't make sense to buy those smaller deals. We want to buy something. I'll just tell you what my buy box is right now. Ideally, it's making $50,000 a month in gross revenue, either now or once I stabilize it. Some non-financial numbers are going to look at, I want a asset that's institutional in nature because you always got to think about your exit before your purchase. So, if you have an asset that is, let's say, 65,000 square feet or larger, you're going to have institutional buyers that are interested in taking that down. Or if you can compile a portfolio of those homogenous assets, you're going to have institutional buyers that are interested. And why is that important? Because they have a much lower cost of capital than you or I do. My investors are making anywhere between high teens to mid 20s on the equity side. And then my debt is usually in the, right now, beginning of 2025, you're looking at maybe like 7% prime plus or minus 25 basis points. That's where my debt is. So my combined cost of capital is, it's in the high single digits, low double digits. Whereas say an institutional buyer, they may have, used a bond to go raise sub 1% equity in Europe and raise $500 million. So now their equity is less than 1%. And they have some type of, revolving line of credit or some credit facility with a large banking partner. Maybe it's, Blackstone or it is Goldman Sachs. So their combined cost of capital may well be in the low to mid single digits, which means that they can pay up for an asset versus if I were trying to sell to someone else like me, I would not be able to get as good of a premium that I would be able to get if I sold to an institutional partner. So 65,000 square feet or higher. That's not necessarily a hard and fast rule. I'm willing to buy assets that are as low as 35,000 square feet as long as there is an expansion component. So it comes with land that's already zoned. It's already, it's ready to go. I just have to pull permits that I can get it up to 65,000 square feet or better. Typical demographic stuff that we like to look at: high median incomes, high visibility, so a lot of traffic counts around our facilities. And then dense residential, because typically apartments have less storage space than, say, a 5-bedroom, 3-bath, ranch home.
Sure. Yeah, and give us the overview and example of a fund that you might raise. So the timeline, the returns investors expect, is it a fund? Is it a syndication? Just give us the brief
Yeah.
details of that.
Yeah, so we have two structures right now. So we primarily work with retail investors, small family offices, wealth managers, RIAs. That's kind of like our typical investor profile. On the single asset syndications, these are typically going to be your larger assets, such as a ground up development of a recreate asset, or a portfolio of, let's say, four, five, six assets that are already pretty stable. Maybe there's a little bit of value add, but not a lot of capex that's needed, not a lot of construction. We also do have a fund model that allows you to diversify across all of the types of self storage that we do. Anything from short term, things that we hold for less than 3 months, where we found an opportunity of a mispriced off market deal, buy it, immediately list it, and then make 20%, 30% bump on it, all the way to long term buy and hold, ground up developments, pref equity on self storage, debt on self storage that we wholesale to other investors, wholesale deals as well. They have a very fast turnaround time, usually 4 to 6 weeks. So as far as returns go, it's basically the same thing, depending on it's a risk adjusted return. So if you're looking at on the single asset syndication side, a asset that's already cash flowing, it already has history, and it's just like a very basic value add, you're looking at mid to high teens, right? If you're looking at more of a ground up development or something that has substantial construction, that comes with a lot more risk than, say, an existing asset that's already producing cash flow. So those deals, you're going to be looking at the low to mid 20s IRR is what you're seeing. And then we're always looking for equity multiples in the 1.8 to 2.5x range over the hold period. Typically on single asset syndications, it's a 3 to 5 year hold period. On the fund, you're looking at a 5 to 7 year. So typically 1 year, 1 to 2 years to raise all the capital and then start deploying. Usually 5 years to get the entire value add strategy done. And then a kind of sunsetting period of 1 to 2 years. So kind of a total of a 7 year hold during that fund.
Sure. Yeah, and you've done 53 of these transactions over the course of your career. What's been the average return on those deals?
Yeah, I'm almost afraid to say because we've had some really kind of home run deals. We target, like I said, that high teens to low 20s, mid 20s, but actualized deals on our deals have gone full cycle. We're anywhere between the 50 to 200% IRR. And the reason why, and I see you're making a face right now, so I'm gonna explain why. So, for example, here's one of the very first ground up development deals that I did. It was a 5 year hold. We build it, we lease it up, then we sell it, right? So this deal was in Mokina, Illinois. It was a southern suburb, affluent suburb of Chicago. We had a project budget to build the facility for $12.7 million. And then after 5 years, we were going to sell it for $18 million. Okay. Well, and what ended up happening is we always give our GCs the option to invest as an LP into the project. And we tell them, hey, if you invest as an LP, you're aligning our interest with us, which is going to make us look more favorably upon your GC bid, right? So we did have our GC partner on that project, Maritini Construction. He invested in the project. We ended up going from a 12.7 cost to deliver down to 10.5 for two reasons. First, the GC was aligned with us, and then second, what ended up happening is right before we got certificate of occupancy in month 12, we were approached to sell the asset to a larger competitor that, what we found out later on, had a 1031 timeline that was ticking. So they went from $15 million offer all the way up to an $18 million offer on an asset that was 0% occupancy. So we took the offer, and in 13 months, we were able to complete our stated goals on the sale price that would have taken us 5 years. So our investor on that project got like 134% internal rate of return, a 2.33x multiple on their equity over 13 months. So there's some of these deals, and then one of the things that we started doing with the value add projects is we always value our single asset syndications as if we're going to sell them individually. But then what we started doing is compiling those single assets based on geography or on the type of asset and the grade of asset into portfolios of 10 to 15 properties at a time. So now all of a sudden you're taking an asset that is, let's say, a grade B, secondary, tertiary market asset. You put it with 10 to 15 other secondary, tertiary market assets, do the value add, put them all in the same management system. And now this deal that you would have sold for $3 million for one deal, now you're selling a portfolio for 25 to 40 million. And that becomes much more appealing to, again, someone that has a cheaper cost of capital than I was originally selling to. So all of a sudden, as opposed to selling it individually, when we sell it as a portfolio, each individual asset gets a 200 basis point premium, 100 to 200 basis point premium on the cap rate, which skyrockets your return. And then at the same time, for the buyers, it reduces their risk because now they're taking on a portfolio of assets where some of those assets may be stabilized, some of them may be in the middle of the value add process, and some of them may be at the very beginning of the value add process. So now those deals that are not stabilized are also getting a push in valuation because the reduction of risk that the entire portfolio brings from a cash flow perspective. And then you get an additional premium on top of the portfolio premium on those assets specifically. So that's how we've been able to achieve these pretty high returns actualized. So it's just part of our three-part strategy. Like I said before, we have the mom and pop roll-ups, which we could talk about later on, the saturation in the market and why consolidation is the play in self-storage for at least the next 20 years. We buy mom and pop assets, value add, put them into portfolios, sell. Then we have another bucket where we buy land in premium areas that would go for, high quality, high rent, multifamily, very high traffic retail, shopping malls, that type of stuff. And then we place a institutional grade asset, usually in the 80 to 100,000 net rentable square feet range, usually getting anywhere between $21 to $24 a foot in rent per year. And then we can sell those off individually, or we can also put those into portfolios with a few others. And then we have a hybrid strategy where we'll buy big box retail that has gone dormant. COVID was, perfect for us for that type of acquisition strategy. So I think of things like Sears buildings, Circuit City, Best Buys, grocery stores. Those are the type of assets that we'll take them down. And we were buying them for the same cost that would have cost us to lease them per year. I bought a Sears building for $9 a foot, when typically in a shopping mall, you're going to be paying anywhere between $2 to $6 a foot in rent per year on a lease situation, right? And then why is that fantastic for us? A, we're walls in already. The envelope is completely sealed off. So if we're building in markets like, the Midwest that gets cold in the winter where you can't pour concrete at certain months, or in the summer down in the South, like Texas on the, the border of Mexico where it's too hot to pour concrete, we are now insulated from that problem. So that not only does that decrease our build timeline from say 12 to 14 months down to 6 to 9 months, but it also reduces our project cost by about 30% because we already have the structure up and we're just having to put in the doors and dividers, the hallways into the asset itself. So interesting strategies there and why we're able to get such high returns for our investors.
Yeah, so you have these high returns and you have these different strategies, right? So talk about the types of debt you use in the certain strategies and why you use that type of debt.
Yeah, so we're all over the debt market, depending on the type of asset that we're buying. So I've used life insurance debt, 10-year interest only debt, with, usually probably 100 to 150 basis points below prime on assets that were already stabilized. And the only value add that really was needed to be done was management, economies of scale, professionalizing management, or adding that asset into a portfolio of other assets to then raise that premium that you're going to sell it for. We have used servicing organizations, so not only for credit unions, but also for life insurance companies. So a servicing unit organization is like credit union is too small to have its own underwriting department. So they subscribe to this service where 10 credit unions end up being the lender on your one deal, and they all participate on a small piece. Same thing with the family office side or the life insurance side, right? Um, if it's higher risk deal, a lot of construction or all construction, then your best bet is typically going to be local bank in that market. They're going to be a lot more aggressive on leverage. They're going to be a lot more aggressive on interest only period, up to 36 months, maybe even 40 months, depending on who you're working with and the type of project you have. However, that deal is going to come with substantial more risk to the GPs because it is full recourse. So 100% recourse across all the GP partners, regardless of how many there are, et cetera, right? If it's a $4 million loan, it's $4 million per GP, not just as a total. So a lot of risk. And then what we've been doing a lot of now, especially as we've been in this odd place in the credit markets where we've been going from a 0%, you know, basically free money policy to now a more stable, benchmark Fed rate. We're having a lot more sellers that if we can show them the value of being the bank where they can get the interest, they get a substantial down payment, we're improving their asset. And in their eyes, the best case scenario is that we fail and default because then they get their asset back. They get to keep the down payment, get to keep all the interest, and now they got an asset back that's worth, 50 to 100% more than what it was when they sold to them. We've been doing a lot of great seller financing at much below market terms. Talking about 7-year interest only at 4%, where our down payment is 18% or 15%, and then we're contractually obligated to spend another $200,000 to $500,000 on capex, or another 5-10%, which we were going to do anyway, right? So if we can count that towards down payment, all of a sudden it becomes a win-win-win. It's a win for us. It's a win for the seller. It's a win for the investors.
Sure. So talk about your waterfall structure and the fees that you charge investors and how the fund is structured. So you have the syndications, the single asset funds, and then the diversified fund across all your holdings.
Yeah. So the single asset syndications the waterfall structures are all different, and I'll tell you why. The market that we're in now, as far as equities go, what matters is not the waterfall. What matters is the internal rate of return that you underwrite to. So if you have a slam dunk deal and you do the regular, European style, 2 points and 20% carry, and that results in an IRR of 45%, well, next time you go to raise a deal that isn't a slam dunk deal and it's not 45%, you're shooting yourself in the foot, right? So you have to standardize your IRR and your equity multiples across every one of your deals. And the easiest way to do that is to start with that end target in mind. So that, call it, let's say it's a value add deal, basically no capex, just all management. Maybe you're going to put it part of the portfolio. Let's say we're shooting for an 18% internal rate of return, 2x multiple. What we're going to do there is we're going to start with that 18%, and then we're going to back into the pref and into the waterfall after that. So we've had deals that was, a 10% pref with a 90-10 split to get to that IRR. And we've had deals where it was a 4% pref and a 50-50 split to get to that same IRR on the single asset syndication side of things, right? The fund's a little bit different because you have the ability to average all those IRRs to the kind of the same area, because you're taking in not only value add assets, stabilized assets, but then also kind of your opportunistic ground up development, heavy capex, maybe expansion project. So the fund, it's a little bit easier to model to because you have all of these different assets coming into that fund. So that typically we're looking at an 8%. What we've seen in the market here and what we've modeled to is about an 8% preferred return. You're looking at the first hurdle after that 8% being an 80-20 up to a 20 or a 22% internal rate of return, depending on your check size. If you're a retail investor, you're going to be on that kind of that 20%. If you're a, let's say you're going to write a $5 million check, you're more on the family office institutional side of the world, then you're probably going to get that, a higher pref with a split that goes up to, let's say 22%. And then after that, the third hurdle will be after the 80/20 will be either a 70/30 or a 65/35, depending on the check size and the type of asset.
Got it. Yeah, so you've invested across 24 states, which is kind of crazy because a lot of people focus on one specific market, and you're laughing right now. So you've invested in basically half the country. So talk about the markets you invest in, why you choose those markets, and then the supply and demand, because a lot of people see self-storage facilities popping up everywhere, and they're like, oh, the supply is too high. They're not going to be able
Right.
to, make a profit. So talk about that a little bit.
Yeah, so I'm laughing because a lot of people that ask these types of questions, they're more used to different asset classes like multifamily, where those answers are really cut and dry. Here's the difference. Let's say you're in Phoenix or you're in Chicago and your tenant raises your rent on you by 16%. You're not going to stay in that apartment. That may be a $200 increase, $195 increase on a $2,000 rent. You'll move anywhere in that city. It's not like you're going to try to stay within a 5-minute drive time of your original apartment, right? Or you may move to a different city just to get a better rent. Self-storage, that is not the case. When it comes to self-storage, if I were to raise your rent by 16% on a unit, that may be $13 to $16 is that increase, but that's still a 16% increase on the return. And this is where the sticky factor of self-storage comes in. No one is going to trouble themselves, rent a U-Haul, spend 2 days on a weekend with their friends and family, trying to bribe them with pizza and beer to help them move all of their crap out of their storage unit to go down the road to save $5 or $10. It's just not going to happen. So here's the thing. 60 to 70%, it's like 67% of the storage users are going to be someone that lives within a 10 to 15-minute drive time of the facility. And it's either they live or they work within 10 to 15 minutes of that facility. So when you say a market is saturated with self-storage, I say, okay, what 3 to 5 mile radius are you talking about as saturated? Because that is the trade area. The trade area is not all of Phoenix greater metro or Chicago metro area. It is truly that 5 to 15-minute drive time or 10 to 15-minute drive time around where the person works or lives. So our investments or our asset class is hyper localized, and I truly mean hyper localized, where if you have a competitor facility that's 7 miles away from you, you may not be pulling any tenants from them, and they will not be pulling any tenants from you. So that's when I always chuckle when someone says, well, it seems super saturated. And it's like, well, it just depends. Did you do the market study? Because if you actually look at the data, most of the country is actually lacking in storage supply outside of like the major, downtown metros like Phoenix, Chicago, Dallas, Fort Worth, et cetera. But if you're in, like, say, a bedroom community, so for my Chicagoans out there, if you are in Chicago and you say you're from Chicago, but really you live in Naperville, which is a 50-minute to 1 hour and 20-minute drive from downtown Chicago, is a great place to invest in self-storage, for example. It's a bedroom community. It's a workforce community that commutes into the city to work. So this is what I typically tell people. It's not saturated. Before the pandemic, 1 in 11 people used self-storage. After the pandemic, it was 1 in 9. During the pandemic, we saw 80% year-over-year rent increases. During that time, the first 3 quarters of the pandemic, of the 1,700 CMBS loans that were made to self-storage, only 3 were delinquent. And during that same time, so that's a 0.17% delinquency rate, which is pretty good for a bank or a lending institution. They'd love that default number, right? During a pandemic, okay? During that same time, multifamily was defaulting at a rate of 1,800% higher, or 18 times the default rate of self-storage. And why was that? Because no one was paying rent. The government said they didn't have to pay rent. And if someone was facing eviction, guess what? They just picked up and they moved to the other side of Phoenix or the other side of Dallas Fort Worth, or they went to or Katy or something like that. They had the ability to mobilize to 1 hour and 50 minutes away from where they're originally living to find something that was more affordable that worked with their current situation. That's not how self storage works. Um, so that's why I think it's a it's a great asset when it comes to both the perceived supply. All you got to do is just do a quick analysis. Back of the napkin analysis is like this: you look at your trade area. So if you're in a more urban, like downtown, large city trade area, you're looking at probably, a 15-minute drive time is going to be a half a mile to a mile. If you're in a more rural setting, like a tertiary market, that 15-minute drive time may be 10-mile radius around your facility. Look at all those facilities in your trade market. If they are at stabilization or better, aka 85% occupancy or better, and you're not seeing any type of discounts or very little discounts, most likely there's unmet demand in that area. And then you can hire a professional feasibility study expert to go ahead and do that market study for you. And if that market study says that there's, for example, say less than 5 net rentable square feet per person in your trade area, probably a good place to develop. If there is less than 7 or 8 net rentable square feet per capita in that trade area, probably a good place to buy in, maybe not necessarily develop in, right? So, and that depends on the type of area that you're at, what part of the country that you're in, but I don't see saturation stopping anywhere soon. We're seeing this massive crisis in affordability in the United States. And what is much easier for a family to do now is, instead of opting for the 3-bedroom apartment or the 3-bedroom home, they go for a 2-bedroom, and then they use storage as an external closet, because that storage facility will have the same amount of storage as that 3rd bedroom, but will cost 1/10 the amount on a rent per square foot basis, right?
Got it. Yeah, so talk about how your deals are structured. Are you guys the lead GP? Do you also co-GP with other groups? And talk about this more strategic partnerships you guys do.
Yeah, so about 65-70% of our deals, we are the only GP on the deal. We do co-GP. We love our co-GP deals, and here's why. I love teaching my competitors to be my competitors, because eventually they will come across an asset that is either too big for them or does not meet their buy box. And the first person they're going to think of to monetize that asset is Fernando, because he was able to offer free advice, free information. If you go to our social media feeds, if you go to our website, we post like 3-4 times a day on literally how to be our competitor, literally. And so what ends up happening is we get these great guys that they're super motivated, and they may just not have one of the pieces needed to do a syndication or to do a deal. Maybe they don't have the net worth needed to get the loan by themselves, so they need a guarantor on the loan. Maybe they don't know how to raise capital from retail investors or family offices, so they bring Fernando and Steven on to raise that piece and then help with the operations and the investor relations, et cetera. Maybe they don't know how to underwrite, or they don't know how to negotiate seller financing with the seller. So there's all these ways that we can plug into a deal. Maybe they don't know how to handle construction at major scale with CMs and GCs, and making sure that they're not getting taken advantage of. So what we'll do is, if an investor finds an awesome deal and they say, hey, I want to wholesale it to you, great, we'll pay you a fee to sign the contract to us, wonderful. Or they say, I want to stay in the deal, so instead of a wholesale fee, can I just retain equity in the deal? Absolutely fantastic. I'm one of those people that think a rising tide raises all ships, all boats, right? So I think to date, like 32% of all of our syndications have been co-GP syndications. We are the lead, right? We're the KP. We're the lead GP on those deals, but we do bring these guys that find these incredible assets along so that we can help them build up their wealth so that they can start doing this on their own as well, right?
Awesome. Yeah, talk about your plans for the future of your firm. Do you plan on staying in the same asset class? Do you plan on getting new partners? What's your plan for kind of building the team and expanding?
Yeah, so we're at a pretty good size right now. Really love what we're doing, not only being extremely lean, but making sure that we're focusing on those home run deals. So what we decided to do when we structured our company was to first build a marketing company. And why did we do that? Because when you're looking for investors, when you're looking for deals, the very first piece that you got to do is marketing. Marketing is the engine of the car. So instead of us having to try to find deals and scrape by if we got a second, second base deal, what we do now is we have such a large funnel that all the deals come into us and we get to cherry pick the best of the best deals that meet our buy box. And then we close on those with our investors. Anything else that may be a good deal, it's not a bad deal, but maybe it's just like a, first base, second base, third base, or it doesn't fit our buy box. Maybe it's a home run, but it's too small or it's too big or the terms don't make sense. Then we have a network of 3,200 other self-storage operators that buy deals off of us. We wholesale those deals to those operators. So that really helps because now we get to see all the deal flow. We get to cherry pick what we like. And that allows us to maintain, we don't have to grow because of growth's sake. We don't need volume to make money. We can cherry pick those deals that are going to be extremely profitable on every deal. As far as the future of our firm goes, we're continuing to grow. We're growing at about 50 to 100% per year. It was a lot faster when we first started. We were at like 200 to 300%, but can't keep that up forever, obviously. And our basically our limiting factor right now is equity. We are starting to have to wholesale deals that fit our buy box just because we can't raise enough equity fast enough. So our next kind of goal here is we're shifting. We have currently about 822 retail investors and 2 family offices that are somewhat small, a couple wealth managers that are also part of the effort there. And now we're starting to shift into allowing larger sub-institutional, institutional operators to come in and write those larger checks, right? Our average check size right now across all 822 investors is $113,750. So like very small check size, right? For a retail investor, that's a lot. That could be a large check size. But if you want to scale a commercial real estate operation, you need to start finding people that can cut 5, 10, $50 million checks, single check writer. And so our goal that we've been focusing on right now is to focus on more cash flowing assets that are more within that buy box, that risk mitigation side of the business, capital preservation side that is beneficial to those institutional investors, sovereigns, the institutionals, the family offices, and then also focus on getting our average check size across all investors up. So trying to get that up to our next goal is to get that up to $500,000. And then that goal after that would be 2 million will be the average check size that we're trying to look for. So that's kind of the goal. And then continue to do what we're doing. We're in the top 100 right now. Our goal is to get to probably, top 30 would be a really good place to kind of settle in at before potentially, selling off the entire brand and the entire company to, one of these institutional publicly traded REITs. But I don't see that, I see myself being in the game at least for the next 20 years. So I think there's a ton of opportunity in the consolidation side of the self-storage business. I know I alluded to this earlier, but just some stats for you here I have on my computer. There's roughly between 60 and 70,000 self-storage facilities in the United States today, depending on what study you look at. Of those total assets, you have 18 to 19% of those assets are owned by the top 6 publicly traded companies. I guess now top 5 because Extra Space bought Life Storage. Then the next 100 largest operators, they own another 12 to 13% of that market, which means you have anywhere between 65, depending on which study you look at, 65 to 70% of the total self-storage stock in the United States are owned by mom and pop, non-institutional investors. So there's
how does that compare to other asset classes? Sorry to interrupt.
It's literally the opposite. So if you look at, let's say, multifamily, you just flip those numbers. The institutional owners of multifamily, and we're talking like commercial multifamily, not your like 1 to 3 unit duplexes, triplexes, quadplexes. I'm talking about commercial apartment buildings. Your institutional investors own the majority of the stock out there. And then your next 100 operators own basically the rest. And then the mom and pop ownership is almost non-existent. So that consolidation has been happening for at least the last 20 years.
Awesome. Yeah. So thank you all for all the information, Fernando. How can investors reach out to you?
Yeah. So I'm chuckling a little bit because I'm a very speed of implementation type of guy. So I'll give you kind of two ways to reach out. If you're somebody that also favors speed of implementation, here's my cell phone, area code 630-408-8090. So 630-408-8090. That is my real phone number. Call or text anytime. It's funny how many podcasts I've put my number on and people are just like afraid to call me or they think it's a fake number. It is a real number. It's my number. If you are, let's say, more of a passive outreach type of person, you can go to our website. It's ssse.com. So 4 letters, S is in Sam, sse.com. So ssse. That's it.
Cool. Yeah, and we'll put that in the description below. Fernando, thanks for coming on.
Yeah, appreciate you having me, man.